Hello and a warm welcome to another edition of Econoday Unplugged. It's Tuesday, 12th of November 2024, and on today's podcast, we have Terry Sheehan on the US East Coast, Max Sato in British Columbia, Brian Jackson in Sydney, and I'm Jeremy Hawkins in London. Well, at least some of the dust surrounding last week's US presidential election having settled, it's time to consider what the result might mean for not just the US economy, but global activity and financial markets in general. We've already seen stock markets and cryptocurrencies hit record highs, ditto currency option trading. The dollar has made broad-based gains as well. Bond yields are also higher, and while commodity markets have been more mixed, by and large, it seems that investors think a second term with Donald Trump at the White House means faster US growth, higher inflation, less accommodative monetary policy, and a stronger greenback. So, Terry, let's, of course, start with the US. Accepting that there's currently a lot of uncertainty about how much of the campaign rhetoric will actually translate into policy reality. What do you think a new Trump presidency means for your economy?
Well, I think, at least in the short term, we're going to see a couple of quarters of pretty strong growth, but a lot of that's in reaction to the election result. It's a lot of anecdotal evidence right now that businesses and consumers are starting to stockpile goods from countries where they expect tariffs are going to go up. And, the actual policies of the Trump administration and what will go into effect is unknown. So at the moment, we have a period of, well, the uncertainty of the election is over. Now we have a different set to deal with.
Okay, fair enough. Already it seems as if a number of sort of city economists are revising up at least their near-term expectations for US inflation, in part due to, as you mentioned, the fiscal stimulus and the various tariffs, etc., which Trump is at least currently proposing. Do you think that's likely? And if so, do you think it's got implications for what the Fed might or might not do next year?
Well, I think if the Trump administration has tax policies they want to implement, they will have every chance of doing so, since they will have control of both houses of Congress.
Mm-hmm.
The implications for monetary policy are that the Fed is going to do its job. If they feel that inflation is ticking up again, they will respond to it. If they don't, then they probably will continue on the current path of slow, steady rate cuts.
Okay, if I can ask you about, this could have been interesting, presumably, the relationship clearly between Trump and Jerome Powell has not been the best in the past. It would appear that Trump prefers a weak or a weaker dollar, but the way financial markets are currently trading and apparently their expectations regarding the impact of his policies, it's been reflected in a stronger dollar pretty well across the board. Now, does that mean that we could well see more political pressure coming out of the White House on the Federal Reserve to cut interest rates at a time when perhaps the Fed wouldn't want to do so?
Almost certainly. From the first Trump administration, we know he does not much like an independent central bank. At the moment, the lineup of Federal Reserve governors and the dates at which they would have to leave office means that the current Fed lineup is going to be pretty much the same through the middle of 2026. But we can definitely expect a lot of rhetoric out of the Trump White House to try and bring rates down more and faster.
Okay, I mean, is it possible for the administration to, let's say, acquire more control over what the Federal Reserve does, or is it fully independent and that's the way it stays?
Well, at the moment, it's fully independent, but of course, they can always propose legislation, and if they can get it through Congress, they can weaken the independence of the central bank.
Mm-hmm. All right, let me ask another aspect of this. Budget deficits. Presumably, we're looking at a bigger budget deficit. If I got my numbers right, I think fiscal 2024, the deficit topped 8% of GDP. Sorry, it was up 8% rather, at almost 6.5% of GDP. In normal terms, at least, it was the third largest on record, and indeed the highest outside the COVID era. Now, presumably, if we do get additional fiscal stimulus, that's going to see that budget deficit rise even more. So is this something you think that the bond markets will be taking much notice of?
I think so. We don't know yet specifically what the new fiscal policies coming out of the White House will be. So it's hard to quantify it in any sense, but clearly they favor tax cuts and trying to shift the tax burden to people outside the US. So how that works out in the long term probably will worsen the deficit.
All right, fair enough. And I guess before we start looking at some of the implications elsewhere around the globe, just quickly ahead in terms of we got the last FOMC meeting of the year taking place in December. We've had certainly at least a weak October employment report and various signals on inflation and the likes. What's the current thinking on what the FOMC might do next month?
Well, the October employment report was weak for a number of reasons, most of which should bounce back coming in the November report because we've seen the strike at Boeing has been settled, disaster recovery in the southeast of the US will be underway and businesses will be reopening. So a lot of that will come back. But I do think overall the labor market is probably growing around the 100 to 150,000 a month. That's actually enough to absorb new workers coming in and keep the unemployment rate fairly low. So I think we can look for the Fed in a steady as she goes mode. I think we'll get another 25 basis point cut.
Okay, and in terms of next year, we still presumably looking at interest rates coming down?
Depends on what inflation does.
Yeah.
I think in the near term, Fed policymakers are probably going to be cautious about cutting too much too quickly.
Okay, fair enough. Anything else you'd like to say before we move on to Max?
No.
Okay, I guess enough so much has been said about Trump and co over the last few days. Let's see what it might mean then for the rest of the world. Okay, Max, where are we? Right, well, according to Mr. Trump, his favourite word in the dictionary is tariff. So he may well know that, in descending order, the 5 largest country shares in US imports are held by certainly China, number 1, Mexico, Canada, Japan, and Germany. Now, Canada comes in at number 3 on that list. And of course, Trump has suggested that he will be increasing tariffs 10 or 20% across the board on all imported goods into the US. So I know that Canada is part of this sort of US-Mexico-Canada trade agreement, but that's up for renewal in 2026. And anyway, it didn't stop him trying to impose tariffs back in his first term. So how important do you think it will be, this talk about all the tariffs and presume the fact we will see some increases coming through? How important is that going to be, do you think, for the Canadian economy?
Both for the economy and Bank of Canada's policy, federal government's fiscal policy here in Canada, I don't think it's going to be affecting the policy stances. Let's see, or measures, actual budgetary measures, or rate cuts until like 12, 18 months later. We're just speculating what the new administration is going to do. And I think not just Canadians, Japanese, even Chinese, they're so used to rhetoric and actual implementation of high tariffs by the US government, looking at what happened under the previous Trump administration. So I don't think there's a huge surprise there. And then even if it happens, I think everybody knows that it's not going to last forever.
Okay, so in which case, what is the state of the Canadian economy at the moment? Obviously, we had the big 50 basis point cut by the Bank of Canada back in late October time. How's the economy going, and what are the prospects for the December meeting?
Surprisingly, or as expected, we're sort of chugging along, and thanks to, I think, dependence on the U.S. economy, much bigger and more vibrant. So that's probably keeping the Canadian employment growth still along the trend line. And I know that the central bank here is also noting that cooling labor market, but at the same time, they're a little bit afraid of the revival of overheating in the housing market.
Okay, but we've had some pretty soft inflation numbers of late, in particular the October CPI, the headline rate, and all the core rates as well were well below what the markets were forecasting. So, I mean, presumably we can still talk about or look for a Bank of Canada cut in December. And indeed, do you think?
Sorry, go ahead.
No, I was just wondering because certainly before the US elections, markets were thinking about the possibility of at least, or certainly 25 basis points, or perhaps even another 50. Is that still realistic, or do you think that's out the window?
It's more like a 25 in December, and later on, maybe on and off 25 basis point pace. I think it's just that. The Bank of Canada is trying to bring the policy rate lower to a more normal level instead of really trying to boost the growth here.
All right, fair enough. Let's try and move on since we've got a lot to talk about. Japan, I mean, fourth on that US import list I quoted a couple of minutes or so ago. So potentially it is a clear target for Trump. The yen, like many other currencies, initially weakened quite sharply on Trump's win, but I guess it's broadly stabilized since then. Now, from a market perspective, there's been this sort of belief that, what a $160 yen rate was about the threshold of pain for the authorities. Do you think, where are we? As we record this, we're talking about a current rate or where are we, about just under 155. Do you think this 160 is still the sort of this threshold of pain for the authorities or not?
Let's see. The MOF hasn't really drawn a clear line in the sand, because if you do that, you basically show your hands.
Yeah. But
that will be a nice round figure. But at the same time, it depends on the pace of the depreciation of the yen. And I think that the one of the most important indicators is the actual U.S. dollar buy positions, in the U.S. So if they can see the weekly data that the U.S. dollar is overbought, then of course there's going to be a pullback. Mm-hmm. But I think that the Ministry of Finance is being careful here too, because I don't think that it's that risky. But once you start hitting the upper end of the dollar, they don't want to push it too far down, closer to, for example, 130, 120. I don't think there's a risk yet, but talking to the BOJ people, there's a bit of a risk in the summer, but I think they're just being careful not to push it down towards 100 yen or something like that.
Okay, fair enough. I noticed from the Bank of Japan, their October minutes, policymakers seem to be, at least let's say, a bit divided on how soon they should raise interest rates. And clearly, at least some of them anyway, don't like potentially heightened volatility stemming from the political uncertainty surrounding what Trump is going to do. So do you think that might be one factor arguing against a move as soon as December? And indeed, do you think ultimately it's still the case, I think as you said previously, that the authorities really looking at wages more than anything else?
Let me put it this way. I think that's going to be sort of a mini swing between high expectations and lower expectations, expectations for incremental gradual hike. And I'm sure they're thinking about raising again in December. If you take a look at the pace, first they conducted the first rate hike in 17 years, March last year. Mm-hmm. So let's see, 3 meetings later in July, a little bit earlier than I thought, but they raised again. And so that's then September, October, December. It'll be a good time to raise again, giving some kind of a guidance to the markets without surprising them too much. And then after December, let's see what's going to happen next year. I'm just pulling up the schedule. So 2025, they obviously skipped January, March, and April is again. It will be a good timing because they have high evidence, not just anecdotal, to confirm where the growth is going and how inflation will be behaving. I'm talking about April 30th, May 1st meeting, and the release of the quarterly outlook report on May 1st.
Okay, fair enough. I guess my last one from me. I don't spend too much time on politics, but yesterday, Prime Minister Ishiba was re-elected in the runoff vote. Any implications there that our customers and clients should be aware of?
As expected, it was in the second round of vote, and that was the first in 30 years. That was also expected. We knew that main opposition leader, know the former prime minister is not going to get it because some of the opposition parties in the opposition are so conservative, they're not going to work with the Democratic Constitutional Democratic Party of Japan. And previously, we thought the leader Tamaki of splinter Democrats called the Democratic Party for the People of Japan, but he's, I think, bargaining has been a little bit eclipsed by the revelations that he had an affair with a woman, while he's married with a son and the kids. So what I'm trying to say is previously, everybody thought, okay, Tamaki is going to be the kingmaker, because look at the numbers here. In the October lower house election, LDP won only 191 seats. That's down sharply from 256 before the election. The September election. And Kome's their junior partner, reduced the seats a lot from 24 to 8. So that means together they only had 215, short of a simple majority of 233. So without the support bill by bill in Parliament by the smaller Democrats, they cannot even pass a bill in the more powerful lower house, even though they have a majority. I mean, ruling coalition is a majority in the upper house. So it's going to be interesting. I think one of the things they had on the election platform by the smaller Democrats, they wanted government to raise the taxable amount from 1.03 to 1.76 or something. That's million yen. So the philosophy behind it is, of course, then spouses and people with the lesser income could continue working without worrying about hitting the threshold, and that's considered the barrier to encouraging more people to go back into the workforce or keeping the overall household income higher. But then, of course, the ruling party, LDP, is really close to the Ministry of Finance. Ministry of Finance doesn't want to accept the demand that's going to really cut the revenue from the income tax.
Right. Okay. Okay. Good stuff. Anything else from you, Max? Like you said earlier, not many leaders, maybe except a few, on a really steady footing. But Canada's Prime Minister also has been criticized. He should go, with it. That's what they're saying from within his own party. So it's going to be interesting. I've been saying it's going to be interesting what's going to happen for months. And but I don't think Trudeau is going to leave on his own so soon. Political instability everywhere. I suppose I haven't gotten to Europe yet, but looks like we're getting a snap German election in February next year as well, just to put the icing on the cake. Okay, great. Thanks for that, Max. Let's get across to Brian. Mr. Jackson, China's export growth in October was apparently the fastest since July 2022. But of course, Trump has said he'll place 60% tariffs on Chinese imports, which will easily account for the largest share of total US imports. He's vowed to revoke China's most favored nation trading status, and with around 15% of Chinese exports currently going to the US. How concerned is Beijing?
Yeah, I mean, obviously, the commentary and official response out of Beijing has been muted and a little bit opaque. But yeah, clearly they're going to be paying a lot of attention to exactly how quickly and how comprehensively President Trump does follow through with these announced policies for tariffs. And yeah, that's clearly a downside risk for external demand going forward for China. You know, as you mentioned, America is a big destination for their exports, and if that really does reduce demand, that's going to, you know, I think, push them to think of perhaps alternative sources of export markets, or, you know, trying to refocus their emphasis on trying to develop domestic demand a bit more fully.
I was going to ask you about that because there's obviously been a variety of these stimulus packages coming out of China over the course of, well, the last several months, I suppose. And last Friday, they unveiled the latest one, which was a 1.4 trillion debt package to ease local government financing strains and presumably help to sort of, stabilise the economy. Now, your markets were clearly very unimpressed that it didn't really include any direct stimulus for the consumer sector. Now, a lot of the talk was that it's the authorities trying to keep their powder dry in case these tariffs do come about. Do you think that makes sense?
Yeah, I think so. You know, obviously they're still trying to gauge the full impact of President Trump's election, and so they will probably want to wait and see before they commit to definitive policies. But it is striking that for so long China has been just relying on this growth strategy of exporting manufactured products and sort of building stuff at home in terms of infrastructure and property. And yeah, it's a very unbalanced growth strategy, and that's something that people have been talking about for as long as I can remember. It's striking that we are seeing a little bit of commentary of people since the election, the US election, trying to put a bit of a positive spin on it, saying maybe this is the final incentive that Beijing does need to try and stimulate consumer spending and consumer demand as a major source of growth. To me, that seems to be a little bit trying to look at the silver lining of the cloud, but it's definitely strengthening those voices within the debate that China is a very big country with lots of consumers, but it's never really been able to get the right strategy in place to rely on domestic demand to drive its economic growth.
Okay, and if I can ask you about the currency, I mean, going back to Trump's first presidency, the renminbi one fell, I think it was about 11.5% against the dollar in 2018, 2019. And that, to all intents and purposes, offset, I think it's something like 2/3 of the tariff hikes which were introduced. Now, do you think if we do see these tariffs come in, there's a greater chance that the authorities would be prepared to allow the Chinese currency to weaken in line with last time to offset the the implications of the higher cost of the higher cost of imports and export, well, affect the exports as well?
It's obviously something that they'll be thinking about. I mean, the difference now is that I'm just looking at the chart in front of me right now. Back then, the exchange rate was around 6.5 when the first set of tariffs were imposed, and as you say, there was about a 10% depreciation against the dollar in the sort of 12 months after that, or 12-24 months. But now we're sort of starting at a level which is already above, where it got to after that depreciation. And we have seen a real determination by Chinese authorities to sort of stop it going beyond, say, 7.3, and we're sort of not that far away from that level already. So there seems to be less scope for them to allow further depreciation this time if they're going to maintain that sort of policy of not letting it depreciate too further. So I guess we'll just have to see whether they're prepared to abandon that sort of previous sort of level that they've been defending, or whether they're going to just not let that currency depreciation work to try and offset the tariffs.
And I guess now what happens there is going to have implications for the Asian bloc as a whole. Because again, if we go back to the previous Trump administration, when the yuan depreciated by 10, 11%. In India, the rupee was allowed to drop by almost the same amount to try and make sure they protected their own current account and so on. Do you think if we were to see the yuan depreciate significantly, that there's a danger of leading to some kind of depreciation battle across the Asian regional currencies?
I think that's inevitable, that you'll have a response from other Asian countries if China does, sort of decide to abandon that 7.3 level and go further. I mean, it's just, it's hard to see them not responding to that.
And presumably for the likes of, the US has got particularly big bilateral deficits with Korea or South Korea, Taiwan, Vietnam. So those currencies or countries certainly could seriously be under the cosh.
Yeah, and again, it's hard to predict exactly how it's all going to play out, but there could be some rebalancing of trade flows within the region as well to try and offset the possible reduction in US demand.
Okay, fair enough. Right, it's moving on quickly then. Australia, I guess what the share of share of US exports or imports, I should say, coming out of Australia is pretty small, so it's not the most important market for you. But has the arrival of a second Trump administration got any particular implications for Australia?
Well, the Treasurer of the Australian government, Jim Chalmers, he actually gave a bit of a speech earlier this week, and referring to some analysis that his Treasury Department had done in the lead up to the election. So they'd actually done a bit of work and research into different scenarios and looking at President Trump's tariff policies in particular. And so he sort of referenced that in this speech. The conclusion that his team came up with was that sure, it would probably reduce Australia's output a little bit just through the trade channel, and also put up price pressures a little bit in Australia as well. But he was pretty confident that it wouldn't be a big impact. And he was also sort of stressing that, we have a flexible exchange rate that could offset that. And we also have, the Reserve Bank could adjust policy if need be. So he was kind of, downplaying the significance of that on the Australian economy, but also sort of mindful of second round effects if there's some sort of trade war or inflation pressures elsewhere in the world. So that's kind of the official word from the Australian government, that they're not expecting it to be a huge concern. And so I think very much the focus here is still very much on domestic issues and the outlook for the RBA.
Hello.
Hello, yes, can you hear me?
Yeah, sorry, you dropped out there. So,
Yep.
Sorry, could you say the outlook for the RBA?
Yes. Yes.
Hello. I think
yes. Hello. Hello, I can hear you.
Okay, please go ahead. Perhaps it's my side, but I can't hear you very well.
No, as I was saying, the focus is domestically still on the RBA, and we had the RBA decision last week to keep rates on hold.
Yep.
And we are still sort of in this position where the RBA is not ruling anything in or anything out, is the comment that they use. And people are presuming that there will be a rate cut, but continuing to push it back. Obviously not by the end of this year, maybe not in the first couple of months of 2025. So it keeps on getting pushed back because the RBA is very unwilling to sort of commit to any forward guidance or any timetable about it. We did have the latest inflation numbers show a drop in headline inflation, but that was largely due to the impact of government rebates for electricity and fuel. The headline rate did come down a little bit as well, but not to the same extent. So I think the RBA is obviously going to look through the impact of the rebates, and they're still not satisfied that underlying inflation pressures have weakened enough for them to be able to loosen policy just yet. So we're still in sort of a holding pattern for the RBA until they are convinced that we're going to get underlying inflation pressures sustainably within the target range.
Fair enough. Any else from your side, Brian?
No, I think they're the two main sort of developments since we last spoke. Obviously, New Zealand, they've already began their rate cut cycle, and they had good inflation numbers last time around. So there's a good chance that they'll feel comfortable in going on further. India is interesting. They're on hold at the moment, and when they mentioned when they had their last meeting, they mentioned that there was a potential for inflation to spike high because of base effects from sort of volatility in food prices, and that is what we have seen. Just yesterday, we had a bit more of we had a second sort of consecutive increase in headline inflation in India. But again, I don't think officials are too concerned about that because they are sort of looking through the short-term volatility. But they're again sort of leaving policy on hold for the time being.
Okay, great. Many thanks for that, Bron. And let's wrap it up then with Europe, which I guess we can say already had enough economic problems to worry about without the US election adding to them. European Union very concerned about tariffs. It's already in a big battle with China over electric vehicles, and the US currently absorbs nearly 20% or so of overall EU exports. For Germany in particular, the US is the most important trading partner by auto. So on paper at least, depending on what actually happens, the economic hit could be significant, and particularly so if tariffs are accompanied by a stronger dollar, which of course would boost inflation and slow, or who knows, even prevent the ECB coming out and cutting interest rates at a time when markets have been talking about at least the possibility of a full 50 basis point ease next month. Euro dollar, the euro's fallen around about 3% against the dollar since the result itself, and more than 5% since late September. So we are starting to see some potential inflationary implications coming through purely from the currency alone. I guess it's worth noting that when we go back to the start of the last Trump term, the euro actually rose quite sharply. I think it was around about 105 in January 2017. It was up at 124 on the dollar by early 2018. But I think that was kind of reflected investors struggling to fathom out just what the Trump administration's policies were all about. Start of a new term, however, they perhaps have a rather better idea, at least from the tariffs and things like that. So it may be that the current dollar rally can be extended. We'll have to wait and see. Apart from the possible implications for slower growth and higher inflation in Europe, the other big issue, of course, will be foreign policy and the willingness of the US to participate in NATO in general and provide funding for Ukraine in its battle with Russia. And here it's not just the politics, but also the financial fallout we need to think about. Overshooting budget deficits are already an issue for a number of Eurozone countries. People remember, 3% is supposedly the upper limit for any member's deficit to GDP ratio. But the Eurozone as a whole in 2023, it weighed in at 3.6%, so above the limit. And within that, Italy was right up at 7.2%, France 5.5%, and Belgium over 4%. So already a number of countries have been told by the EU Commission they need to do something with regards to fiscal retrenchment. However, a more isolationist stance from the US will mean that Europe's going to have to boost defense spending just to protect, something close to Ukraine's current front lines. That's going to add to borrowing requirements and clearly put additional upside pressure on yields as well. Much the same story applies to the UK, and indeed in some cases the effects could be more marked, as the US accounts for 15% or so of total UK goods exports. Indeed, it has the largest single country share. In addition, in UK financial markets, they're already struggling to digest the new Labour government's first budget, which was announced last month, which in a nutshell amounted to the biggest tax increase in 3 decades and added the best part of 140 billion sterling or so to borrowing in coming years. This contributed to a surge in gilt yields and as a result, a tidy rise in mortgage rates too, and the biggest 2-day fall in the pound's trade-weighted index in 18 months. So difficult financial conditions already. In addition, the budget's been estimated to add about 0.5 percentage point to UK inflation, which the bank now expects to take at least a year longer to fall back to its 2% target on a sustainable basis. So that's made the Bank of England's job all the more problematic. Bank rate was cut 25 basis points to 7.75% last week. That was an 8-1 vote, but another ease in December now looks that much less likely. So UK will certainly be hoping that the so-called special relationship with the US still holds, although it's worth remembering that that didn't help with the free trade talks with the US that were the previous government promised after Brexit. Indeed, they never actually took place. Quickly round off on Switzerland. US share of Swiss total exports was about 15% last year, making it the top destination. And of course, it's got a sizable trade surplus for the US as well, which means it's going to presumably on Mr. Trump's hit list. So for Switzerland, the big worry has been that US policy uncertainty would prompt a fresh surge of capital into the already strong Swiss franc. That remains by some ways Europe's #1 safe haven currency. Indeed, we even had the Swiss National Bank talking up the likelihood of intervention if the currency were to appreciate after the election. Significantly, we've seen Swiss National Bank sight deposits, and that's, if you like, a sort of proxy for FX intervention. They rose very sharply last week after falling in each of the previous 5 weeks. So it's kind of a tentative sign that the SNB has been busy already in the market trying to keep some kind of lid on its currency. Swiss franc has lost ground against the dollar, but certainly it's strengthened typically against most of its other European counterparts. All of which then, with Swiss inflation still very, very low, probably makes what would be a 4th straight policy rate cut in December all the more likely. Okay, that's it from Europe, and I guess from us as well. In conclusion, well, I guess while we won't really know until next year what President-elect Trump's policies will look like, if history is anything to go by, it will be a volatile period for financial markets. And indeed, there could well be a sharp difference in both economic and asset price trends between the first half and the second half of his term. In any event, as always, it will pay to keep a close eye on the data. And the best way of doing that, of course, is by using Econoday's global economic calendar. And with that, on behalf of Terry, Brian, Max, and me, thanks as always for tuning in. We look forward to seeing you again next time. Bye for now.